If you go back to when gold was legalized by the government in 1975, and you look at the prior bull markets that occurred in that 50-year period, one took us from a low in the 76 low was about $103. It dropped from 200 down to 103, 75 to 76. And in the next 3.5 years, gold went up eightfold, $103 to $850. Okay, 1980. Then in 2000, 2001, gold was bottoming at around 260 repeatedly. Quiet bottom. Wasn't going back to $50 again, back to 100 or even back to 200. It was at 260. Okay. When it turned up, it went to 1820. Took it a decade. Longer time span. Another eightfold move. Okay. Now we have more fundamental dynamics now and technical dynamics than we had either of those times. So to expect it to just go an eightfold move is probably a mistaken notion, but even go eightfold, means gold's going to go in the mid 8,000s. Why? Because our bear low was 1,050. We're only halfway logarithmic dimension of those prior two bull markets. So everybody says it's overdone. It's only half as much as those prior two bull markets when you do a ratio scale, price to price advance. What percent gain did you make? So gold is only halfway, even just getting to the norm of an eightfold move. And I doubt it'll stop there. But even if you have an eightfold move, I mean, that's doubling from current levels. And that would shake the world as well. And no doubt there would be reasons for that people would look back and say, aha, now I understand why. And some of those reasons are starting to come into place right now. Gold's only halfway the same metric move that it made twice before in the last 50 years. So figure that in. Even just to match those, you go 8,000 plus. Okay. Silver versus gold is very depressed historically. And it looks like it's on the edge. Technical breakout versus gold, which will get it back to normalities and probably to some high levels, which we're 1.24, 1.25% of the price of gold right now. Divide an ounce of D silver into gold. You end up at 1.24, 1.25. There's a spread breakout above 1.3%. Not far above it. When you break out of that, that's when I set the clock on that 6-month issue. Not now. I'm waiting for that spread to break out. When that occurs, I'm arguing that in the next couple quarters, give or take, you're likely to see silver go berserk. Gold's going up too, but silver go berserk, net price-wise and relative to gold. Catch up for old realities they've been stuck in, unjustifiable. It made a mistake. Maybe it was imposed from above, but it made a mistake. And when it wants to reprice itself, it won't do it gently. It'll do it in a thunderbolt. I think we're on the cusp of that. The other thing to watch is gold versus S&P. Again, we put these in every week we issue these updated charts. When those two things break out, I pound the table and say, if you're an investor, shift your mentality out of the stock market into gold. Even if you don't think the stock market's going down, fine. Okay. Gold's going to beat it regardless. Because when that spread breaks out, it is a huge technical event. And nobody's talking about it. All they're talking about, gee, gold's overdone. You don't know what's overdone. There's other factors out there, like you mentioned, monetary reset. Fiat currencies have not worked. They've created ongoing debt, ongoing monetary growth. Government uses these pieces of paper to do what they want to and print the money. And the consumer, the average guy, has to pay for it in the sense that the dollar in his pocket 10 years ago is worth half what it is. When your dad built a house, it was your granddad built a house, $4,500. Your dad built one, $45,000 medium home price. Now it's $450,000. That's what I mean by degradation of the money unit. So the fact that the S&P's gone up, like if you go back to 20, 25 years, pick the same month, November, S&P's gone up, what? As much as the money growth. It really hasn't beat the money growth, M2 growth. Gold's beat it handily. Nobody acknowledges that. Yeah, there's ups and downs, but the issue is to protect yourself from the con game of that piece of paper or the euro or the yen, same story. And now we have a government debt crisis when the Fed has to say, we're going to step in and buy the bonds. Oh, it's only because of illiquidity. No, it's not. The market is in trouble. And if it starts down, the world ends. It's bigger than the stock market. It starts down, the upper yields. And we're watching the T-bonds very closely, and they're not far above levels, which if they roll over again, this time it's going to be a headline type story. And it's too big for the stock market to ignore. It's the kind of thing that'll derail every assumption you've got about the stock market. And do what? Cause the central bank to go ape. That's blood for gold. Gold's ongoing trend is to keep its value. It always does. Decaying money over decades, no problem. Gold holds its value. Very little else does. And that's what's really going on here in the big picture.
When analyzing any major asset transition, the starting point is always the long-range structure. Price alone misleads more often than it informs. What matters is how that price behaves relative to its moving averages, to other asset classes, and to its own historical baselines. When you look at gold through that lens, it becomes clear that the current move is not an aberration, but an extension of a trend that began quietly in 2015, when gold bottomed near $1,050 and refused to break lower, despite widespread consensus that the bear market still had more to run. That refusal was the first tell. Markets that are supposed to break but don't are markets that have already decided their direction. From that point forward, each corrective event, 2018, 2020, 2021, 2022, held above the same long-range momentum structures. That consistency is significant because mature markets rarely give you clean, persistent momentum support unless something foundational has shifted beneath them. It's similar to watching a river swell slowly before a break in the dam. The pressure builds invisibly before it becomes visible. And once visible, it becomes impossible to contain without external intervention. The same applies to the behavior of gold relative to the equity markets. Divide the S&P 500 into gold month by month across the past decade, and you see a nearly horizontal base, a massive 11-year range. Markets do not build decade-long bases unless they are preparing for a structural change. In fact, the longer the base, the more powerful the breakout. What we have right now is a spread pushing against the upper boundary of that structure. A monthly close above that line would represent the first decisive relative breakout in over a decade. And when gold breaks out relative to the S&P, the implications extend far beyond traders' screens. They affect pensions, sovereign wealth funds, algorithmic allocators, and multi-asset strategists whose models are built around relative performance thresholds. This is why the talk about gold being overextended misses the actual dynamics. It is not overextended, it is early. Momentum leads price, and momentum long ago told you the internal foundation was shifting. What we are witnessing now is simply price catching up to a story that began years before most investors noticed. The public is late not because they are reckless, but because they have been conditioned to follow price rather than structure. And structure is what matters most. Silver's position is even more compressed and therefore potentially more volatile once the ceiling breaks. For 3 years, silver's relative performance to gold has produced a staircase decline. Lower highs, lower lows, all contained within a gradually sloping downtrend. But this downtrend is not random. When you plot the spread, each rally in silver relative to gold stops at nearly the same horizontal level. That repeated ceiling has created what technicians call an accumulation lid, and silver is now pressing that lid again. A weekly or monthly close above roughly 1.30%, meaning the front month silver price is 1.30% of the front month gold price, would constitute a breakout. And once that breakout occurs, silver historically does not grind higher, it accelerates. To understand why, you have to appreciate silver's structural size. Global annual silver production, in dollar terms, is only around $30 billion. That is a small market pretending to function like a large one. When structural demand begins to shift into such a small space, price elasticity disappears. And when elasticity disappears, the slightest imbalance between supply and demand produces magnified price responses. This is why markets like copper in 2005 or lead in 2007 quadrupled not over decades, but over quarters. They were undervalued for years, compressed inside unnatural ranges, then suddenly repriced when reality returned. Silver is aligned for the same dynamic.
We ran studies over the last month in our weekend reports where we looked at copper, for example, back to 1980s, 70s, 80s, 90s, 2000, 2005. Copper was in a dead range, or in a range. It's where it lived in. It was this reality, up and down, just like sort of silver's done for 50 years. $50 down, $50 down. Now we're tangling with 50 area. But when copper came out of that range, and it was late 2005, early 2006, it quadrupled in price in a couple quarters. And hey, new reality. It didn't incrementally go from 1 to 4 level. Okay, it did it in a couple quarters. And then, yes, it's a violent sell-offs, but at levels that are now 4 times the height, 4 times the average price of that multi-decade range that prevails in the 80s, 90s, 2000, etc. And then we looked at lead, exciting market. It did the same thing. It was in a dead range, 70s, 80s, 90s, 2000. And in 2007, it broke out its old reality, and it quadrupled in price in a couple quarters. Not coincident with copper. That was a year prior. Lead did it. And then lead has lived in a zone of reality, a new level that's 4 times the price level of that zone of reality back then. Okay, now look at gold. The mama market was silver, monetary metal. Gold made a high at 850 in 1980, made a high at 1920 in 2011. It was up in the mid 4,000s. Okay, what's silver done? 50, 50, 50 area. What's going on? What's restraining it? Well, it's not an issue. There are arguments that are solid that it's been manipulated. We know there's even been some convictions in that regard. But we also know that when you try to distort reality by artificially suppressing something, talk about even when governments try to do it, because they can't withstand ultimate market pressures. When it unleashes in a tantrum. Now, we all know in hindsight, investors with any maturity do, that markets make bubble tops, like the stock market, like the .com or the mortgage crisis was building from 2005, 6, 7. Market ignored it, didn't care. And finally, when it cared, it fell apart, but ignored reality. And therefore, another bubble top. Or 29 was a bubble top, 23 to 29, then collapsed 80% by 1932. We all know in hindsight, markets make excess on the upside, but they also make excess on the downside, where maybe a market goes down hard, but maybe too hard, and it lays there dead for a couple of years, and investors just pass it by because, heck, it's nothing going on, right? Just ignore it, forgetting, of course, that it's dirt cheap. And when it wakes up, suddenly it's like a thunderbolt. It's not like a little creepy crawly thing. It's quite common. But we're arguing silver's in that same position of moving into a new reality. It has all the reasons. Plus, we have a bull trend. Silver's in a bull trend. Gold's in a bull trend. And when we measure certain other metrics, not just look at the simple price chart, which everybody does, and every time there's a $3 drop in silver, it's the end of the world. I buy into them, okay? If you measure, for example, the monetary metal mama, gold, versus the S&P 500. In 2011, when gold peaked, it came down in price, and it really came down in 2013 into 2015. 2013 was its real bad year. And during that time, if you measured gold owning it versus the S&P, you were a loser. Gold was losing value to the S&P. But starting at the 2015 low, when gold made its low at $1,050.
When comparing the present gold move to the 2 major precedence cases since legalization in 1975, the conclusion becomes difficult to dismiss. Those prior bull markets contained 8-fold expansions off their structural lows. The 1976 low near $103 launched an ascent to $850 just 3.5 years later, and the 2001 pivot around $260 gradually unfolded into the 2011 print near $1,920. In both events, momentum structures aligned earlier than price did, telling you the underlying reality had shifted even when surface volatility suggested otherwise. Today, gold's structural low, around $1,050, implies that even a basic proportional analog would target the mid-$8,000. And that's assuming symmetry with prior cycles. My suspicion is it won't stop there, because this time the monetary backdrop is qualitatively different. The underlying distortions aren't merely cyclical, they are systemic. What has changed most dramatically is the condition of the sovereign bond markets. These were once the stabilizing force behind fiat credibility, but they have become the weak point. When you listen closely to what major central banks say versus what they actually do, the divergence is the story. The Bank of England was forced into emergency gilt purchases last year under the euphemism of liquidity management. Japan has intervened repeatedly to slow yen deterioration while simultaneously suppressing portions of its own yield curve, creating reflexive instability. And the Federal Reserve, despite publicly projecting discipline, is one liquidity crisis away from another involuntary pivot. The global system is no longer anchored, it is drifting, and that drift always resolves through relative asset revaluation. Commodities with a monetary function are the recipient of that adjustment. This is why gold has outpaced M2 expansion over the past 2 decades, something the S&P cannot claim. People often mistake nominal asset inflation for true gain, but when you measure major stock indices in gold terms rather than dollars, much of the apparent appreciation dissolves. This is why understanding relative performance spreads is crucial. Price alone is the surface. Relative strength is the underlying tectonic plate movement. When gold begins outperforming the S&P on a sustained basis, and the spread shows an 11-year base preparing to break, that is not a short-term trading signal. That is an inter-asset migration event. It is the starting gun of a decade-defining reallocation. And silver's position relative to gold is another piece of this puzzle. The spread between the metals is historically depressed. A division of front-month silver into front-month gold yields roughly 1.24 to 1.25% right now, which is near the lower boundary of its multi-year performance range. But more important is the structure that has developed since the explosive 2020 silver rally. After doubling off its March of 2020 lows while gold rose roughly 40%, silver exhausted itself in early 2021 and entered a staircase relative decline. That decline carved a flat-topped range, 3 visible ceilings over 3 years, and the spread is now pressing that ceiling again. A weekly or especially a monthly settlement above the 1.30% threshold would constitute a clear structural breakout. If that breakout occurs, the clock begins. Silver tends to compress reality before revaluing, not unlike copper in 2005 or lead in 2007. These were markets that spent decades in narrow lethargic ranges only to suddenly quadruple in price over a few quarters. That behavior wasn't random. It reflected the unwinding of long-term distortions. Silver shares that profile but operates in a monetary context rather than a purely industrial one. When a monetary metal transitions through a structural ceiling, its reversion is typically sharp, disorderly, and vastly disproportionate to the prior compression. It does not creep, it leaps. And once it leaps, it rarely returns to the prior zone. Several metrics support this expectation. Lease rates remain elevated. Borrowing costs through SLV's short-side pipeline show strain. Backwardation episodes, while not persistent, continue to emerge. An anomaly in a well-functioning commodity term structure. Backwardation itself is a signal of pressure in the physical market, but more importantly, it indicates a willingness among traders to pay a premium for immediate possession rather than accept paper substitutes. And whenever that preference grows, the ability of derivative markets to dictate price erodes. This is the same dynamic gold and silver faced during the 2008 stress period, though in that case the fundamentals were not as aligned as they are today. Back then, both metals saw violent paper-driven declines. Gold from $1,000 to $700 and silver from $21 to $9. But the physical markets told a different story. Mints shut down repeatedly, refiners imposed long delays, premiums soared, and availability vanished. The paper world screamed collapse even as the physical world faced shortages. When you get a divergence of that magnitude, the reconvergence is never gentle. Today, the physical stress is not episodic. It is structural. Delivery demand on COMEX continues to trend upward. The migration of metal eastward is no longer a headline. It is a years-long conveyor belt. BRICS accumulation is not a temporary phenomenon, but a transition in global reserve preference. And prices are responding, albeit gradually, as the market adjusts to this imbalance. Silver's supply-demand deficit illustrates the point. You cannot suppress a market indefinitely by lowering its incentive to produce. If you hold prices artificially low through derivative overissuance, you implicitly reduce the profitability of mining. Miners then reduce output. Over 5 years, those micro decisions accumulate into a macro deficit. Annual mine supply stagnates, industrial use continues to grow, and monetary demand increases. The result is predictable. Tightness appears first in leasing rates, then in backwardation, then in availability relative to paper claims, and finally in price. Silver is somewhere between stage 2 and stage 3. I pay close attention to long-range momentum structures because they tell you when a market is tired of its old equilibrium. Silver's long-term annual momentum broke out last year despite price stagnation. That divergence is often the first sign that the market has internally shifted. When momentum leads price, price eventually follows. The lag can be months or quarters, but the predictive value is reliable.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.